Hi, everyone. Welcome to this session where we're going to be discussing physical risk and resilience. We're fortunate to have a couple of case studies from participating institutions in UNEP FI's TCFD program on climate risks and opportunities. I'm David Carlin, the leader of the TCFD program at UNEP FI, and glad to be here to discuss this important work in the context of adaptation. And this is one of many great events that are on the slate. You likely have heard from my colleague Remco Fischer, and we'll hear from many other participating institutions that are UNEP FI members that have worked with the Global Center on Adaptation as well. And in this particular session, we'll talk about some of the methodologies and applications of physical risk. And specifically, I'm fortunate to be joined with Marieke and David from Rabobank and Standard Bank, respectively. And after I introduce our TCFD program, they will talk a little bit about case studies from that program. Then we'll conclude with a couple short questions for the sum up, and then you'll be able to move on to the next session. So briefly to talk about the TCFD program that UNEP FI ran, we're really glad to have a very global representation, and we recognize, of course, that climate is truly a global issue that really leaves no region or sector unaffected. And so having the participation from nearly 40 global financial institutions was particularly important, not only in presenting a diverse perspective, but also in getting a real sense of the practices and challenges faced by institutions across the world. This program really built out of the success of the prior programs that UNEP FI has run since 2017. So once the Task Force on Climate-Related Financial Disclosures, the TCFD, had issued their recommendations, we've been working with members of the financial sector to help implement and address those recommendations. So in our program, we partnered with a number of modelers and providers to really help institutions develop methodologies and explore existing methodologies for assessment. So we, through the program, worked on the physical risk blueprint with Acclimatize, a consultancy focused specifically on physical impacts of climate change, and we'll speak really about that work today. So I'll go into a bit more detail with that momentarily. We also built a transition risk web tool, a implementation supported by Oliver Wyman to help institutions evaluate transition risk across a number of sectors. We also had a good discussion and number of case studies that went into putting together scenario papers on how institutions are using climate scenarios, how they plan to use them, as well as other topics such as the implementation of climate risk information into operations, and also building heat maps on both the physical and transition side. So as I said, we'll talk a little bit more in this session in the next 5 minutes about the physical risk work, and then we can go into the specific case studies with our institutional representatives. So in the Charting a New Climate report, the blueprint report that we worked on, our aim was really to provide a comprehensive view of climate risk to institutions, but also what specifically they should be thinking about on the physical risk side. And so the way we put this together was to assess what data and what tools are out there, also to develop a correlation analysis approach for linking extreme events and asset values, thinking about how we do risk identification through heat mapping, and then going into the opportunities side of TCFD as well. So that was the real structure of the the report, and we urge you to read the report and look at the case studies and examples. It's currently on our website at UNEP FI, and you'll be able to see the work that was done. Talking briefly about each of these components, on the assessment of data portals, one of the visions was to look at one of the gaps that we saw in the first phase of banking work, which was specifically a need for better data, more data, and data with greater granularity. And so one of the assessments that we went through with the institutions for a number of providers was to explore how they cover different hazards, what types of scenarios are covered, time periods covered, and also other degrees of granularity to really give a guide for institutions in thinking about the data that they need as well as the data that is available. We then thought about not just the overarching data, but also how we begin to use that data and how we begin to use insights around climate risk. And so one of the key exercises is in risk identification and determining where your material risks and exposures are and what kind of time you want to spend in thinking about that. And so the group of institutions got together to specifically discuss the series of a variety of different sectors and how those sectors would be exposed to potential risks to natural resources, to changes in market demands, to changes in labor market. And ultimately, the vision here was to look at which sectors are particularly impacted by physical risks and to think further about how we not only assess those, but in looking at some of the higher risk areas, how we look at those vulnerabilities and think about further analysis and action. On that topic of further action, the next component of the work really focused on tools for physical climate risk assessment and thinking not just about what data and what identification we've done, but also how you convert those into financial impacts. And so we looked at a number of providers and explored the scenarios they offered, the risk metrics provided, as well as the hazards contemplated, with the desire to get a sense of not only how comprehensive these were, but also methodologically where there are similarities, as well as where there are areas that perhaps the market isn't necessarily fully covering yet. And so we think that there's been significant advancement and progress, but work still needs to be done to ensure that the outputs and the complexities of financial activities are adequately addressed. One of the ways of actually quantifying some of this a little bit more was in work that we had done with Professor Rob Wilby, a hydrologist who has done extensive research on the relationship between extreme events and the change in asset values, both for real estate and agriculture. In this exercise, we looked specifically at real estate and did a piloting exercise of thinking about how do you connect the increasing severity and frequency of various events with the change in asset values by looking both at historical data and developing some correlations and relationships that use statistical techniques in order to validate and support those relationships. Finally, on the opportunity side, we looked at aiming to think about opportunities and how a hierarchy of opportunities could be explored through the evaluation both of how the market is likely to change, but also how that individual institution is likely to be prepared to assess and to deal with those challenges. And so the vision was to kind of start with sectors that are likely to grow and see opportunity, and then move into subsectors that are likely to benefit, and then look at the specific nature of companies in order to come up with a actionable strategy to triage these opportunities and to decide whether to take action, to finance, to support, and I think that this is particularly important in the case of adaptation actions to think about that there is such a financing gap, and so identifying where growth will be is a really key element.
I don't know.
Just to talk briefly about the new work that we'll be doing. So that really covers what is in the report of Charting a New Climate. What we're doing to build on this is in our next phase of TCFD work, we're looking ahead to helping institutions develop a comprehensive report by providing them with the techniques to identify, measure, and manage both the risks and opportunities posed by climate. And at this point, this number has actually since increased, but we have increased to 35 banks and investors working together. I think we'll likely add substantially to that in the coming weeks. And this will be similarly a global effort to explore and confront the various challenges that are faced by institutions around the world, both on the mitigation side as well as on adaptation. So now I'll open it up to the case studies and turn it over to Marieke from Rabobank to talk about her work and the work of Rabo in our program. So welcome, Marieke. Please introduce yourself, and we'll give the presentation over to you.
Here today. If I go to this is the first slide, and maybe I think you all know this picture. It's the picture of heating up the earth in a graph. So what is the presentation about today? I would like to start with a brief introduction on Rabobank and how we look at climate change risk. Then we go to the heart of the presentation and the physical risk analysis we performed this year, namely the wooden pole rod foundation problem. And I have to be honest, this is really a Dutch problem. So I think the rest of the people, the rest of the world doesn't have this problem. So, but that's the reason why I wanted to touch this, this specific Dutch problem. So let me start with the introduction of Rabobank. Well, as you may know, Rabobank is a global corporation with a focus on the food and agri sector. We do recognize the importance of limiting global warming to less than 2 degrees and thus signed the Paris Agreement. And our mission is to finance the transition to a low carbon economy. If you look at the right of this slide, you see the sectors we are financing globally. The sectors we are most exposed to are households, and basically that means our mortgages, and again, the food and agriculture sector. Then I would slightly touch Rabobank and how we work on climate change risk within a bank. We see climate change as a topic we have impact on as a bank, but also a topic which has impact on our clients and on our balance sheet. So we see climate risk as the ability of our customers to repay their loans. Our climate risk project team, set up a couple of years ago, is responsible for quantifying the climate risk Rabobank is exposed to. We started, let's say, 2 years ago, and we also joined the UNEP FI TCFD first pilot, the second pilot, and we are really looking forward to join the third pilot as well. Like what David mentioned in the presentation before, it's really a good pilot to learn about climate risk, to learn about the methodologies, about the shortcomings, and about the way forward. So what we did with our climate risk project team, we have a long-term plan, let's say 5 years. So every year we make a 5-year plan, and we work according to the TCFD recommendations to embed climate risk within our organization, and we are focusing on governance, strategy, risk management, metrics, and targets. So now, the heart of the presentation, the physical risk case study, Dutch houses at risk due to drought. And what I said before, it's really it's about foundation damage in the Netherlands. and it's called foundation damage. That's how we call it in the Netherlands, and it's really a Dutch problem. Well, I start with a summary of the assessment we did this year. Foundations of Dutch houses are being impacted by the recent droughts, and because of climate change, it's expected that these droughts will occur more frequent. This means that the current foundation problem will increase over time, and that the damage it causes is estimated between 5 and 45 billion euro up to 2050. Our customers, the homeowners in the Netherlands, and if you look at our mortgage portfolio, I think we finance, let's say, 21% of all the houses here in the Netherlands. Our customers can be unpleasantly surprised by a financial burden due to wooden pole foundation damage. And the biggest risk for Rabobank lies with the customers who have a difficulty to finance the foundation repair. And we estimated that on average, a homeowner has to spend approximately 60,000 euro to repair the damage. But if you have a big house, it can easily run up to 250 or even 300, 400 euros to repair the damage. So, what is foundation damage? For a lot of you, it will be a new topic. And on the right-hand side here, you can see the problem. It's a wooden pole and it's rotten. So until the 1950s, the Netherlands used shallow foundations and wooden pile foundations in clay and in peat soils. And due to more frequent droughts, the groundwater levels drop and foundations are susceptible to damage. The damage process is generally slow, so it can take up to 10, 20, 30 years, but the damage can occur faster if there is a sudden lowering of the water table. In a drier climate, and the Netherlands is certainly in a drier climate since a couple of years, it's a huge trigger to accelerate foundation problem because of the lower groundwater. And rotten foundation can even lead to uninhabitable houses. And at last but not least, there is no insurance for damaged foundation in the Netherlands. So what did we do? How did the assessment look like? Well, the first phase was data gathering. And that's basically the most important and also the most difficult part of the assessment. We looked for useful data sources to indicate the risk of rotten foundation to residential real estate. And we used basically public available data from CAS. And that's a data set indicating which neighborhoods are prone to be affected by rotten foundations until 2050. After that, we expanded the forward-looking risk indicator of rotten foundation to the entire country. And for that, we used the public BAC data of the Houtland Registry and the foundation problem data of TCFD. And the outcome is a forward-looking, until 2050, estimation of the rotten foundation risk for almost every corner of the Netherlands. The map on the right shows 4 risk categories. These risk categories indicate the likelihood that houses are built upon wooden poles and might be exposed to low groundwater levels. So now the next phase. We started with the estimation, that's the calculation of the impact on the mortgage portfolio. We started with the estimation of the materiality of the risk. Basically, the mortgage portfolio has been linked to the risk areas of the map I showed in the slide before. And we found out that it's expected that a small part of our portfolio of large risk category will suffer damage. Good to mention here is that in the Netherlands, you can get financing up to 100% of the market value of your house. So if you want to buy a house and the value is 300,000, you can get a mortgage for as much as 300,000 euros. What we also found out is that for a very limited group of customers, it will be hard to qualify for an additional mortgage to repair the foundation. And that's the heart of the matter and at most difficult, because they are already in financial difficulties or because they are financed up to 100%, so the maximum amount, so they are not be able to finance the damage repair. Another thing I want to mention here is that because of the rough numbers and the estimations and assumptions we had to make, we consider this assessment as a step forward in physical climate risk insights, but we are not there yet. So, and this is my last slide, the physical risk case study, our strategy. We follow the evolution of the risk because, as I said before, this is a first step in the right calculating direction. In case more up-to-date research, and we are expecting more up-to-date research, because in the Netherlands we are really focused on water and groundwater levels, because most of our houses and most of our ground is 60% of our houses are below sea level. So there are a lot of consultants and a lot of institutions who are really focused on this technical side of foundation damage. So because of that, and we think this is a very good first step and a good calculation director, in case more up-to-date research and data becomes available, we will perform a more detailed case study. And the last thing I want to mention, and that's really hopeful, is that, and it's really hopeful and very encouraging and useful for our clients, is that as of next year, houses in the Netherlands will receive a foundation label when they are appraised. So this label, it's E, B, C, or D, indicates the risk that the house will subside, and that the new owner will have to repair or even replace the foundation. So that was the last slide of my presentation. Thank you all very much for your attention.
Hello, everyone. Thanks, Marieke. Thanks, David. My name's David Goldsworthy. I'm with Standard Bank in Johannesburg. I'm a senior risk manager in the group risk team. I was a member of the TCFD working group in phase 2 of UNEP FI's pilot program. And happy to be here today to share some reflections on the physical risk case study that we performed on the program. The bank's involvement in phase 2 of the program involved participation in a number of case studies, including trial testing of physical risk tools that were developed in phase 1, a review of commercially available tools for physical risk measurement. But today I'm picking up on David's earlier slide around module 4, which is a case study that we did on testing for correlations between physical risk events and expected movements in asset prices and valuations. Interested readers can find this case study on page 80 of the Charting a New Climate report that was issued in September last year. So the objective of the study was to apply some of the learnings that participating banks received around what was defined to us as climate gentrification. That's the increase in real estate values for properties that are more resilient to climate-related hazards, such as floods, storms, fires, etc. So for our purposes, Southern Africa being an arid region, we elected to undertake a study that tested whether there were associations between movements in property values on the one hand and the incidence and intensity of wildfires for a region in Southern Africa on the other hand. We looked at doing what was defined to us as type 2 analysis, being that relied on usable time series for property values in different areas. We didn't have good data in that regard, and so the study focused on evaluating average property prices before and after a single identified major wildfire event. This event happened in 2017. Importantly, we stated up front that our work wasn't intending to arrive at any conclusions on whether changes in climate had exacerbated the dry and drought conditions that made the environment conducive to the fire event. We were more interested in understanding the extent to which real estate prices could potentially be informed by physical events such as fires. So the region selected for testing, which you'll see we've called the fire area in our report, it was chosen deliberately for its dry climate. It has a history of prolonged droughts and wildfires. We sourced hazard data for a 20-year period, and we focused our analysis, as I say, on that one particular extreme wildfire event, mainly because of its intensity and duration. And so that was the measurement point for examining price movements. To build the climate hazard data set that we needed, we used the open source database housed by NASA. That's the Fire Information for Resource Management System, or FIRMS. It's got a great archive of satellite data for major fires around the world. Each data point included longitude and latitude coordinates, the date of the fire event, and the intensity or the brightness of the fire, which we used as a proxy for the size and duration of the fire event that we were interested in. On the other hand, to build the asset value data that we needed to measure against the fire event data, we used our bank's mortgage lending exposure portfolio data, which importantly for this type of analysis did include spatial data fields such as postal codes, which we mapped to latitude and longitude coordinate data. And this locational data really is critical to isolate those properties located within what we call the fire zone, which we'd identified for testing. And so we overlaid this property exposure data with valuations data, which we sourced from our valuation service providers. So we had exposure data by property, we had location data, and we had valuation data. So then looking at the slide, I realized it is somewhat small. More detail and more clearer detail is available in the report. The chart on the left at the top, we show a comparison between growth in average property values before and after the fire event for different time periods relative to other regions in Southern Africa. So, for example, you may not be able to see it, but our fire area grew by, prices in that area grew by 1.35% in the year after the fire compared to the year before it. But in the region N3, for example, they grew by 9.18% over the same period. So the graphic below that is the results of our application of quantitative geographic information system, that's QGIS, which was used here to illustrate the location and intensity of fires over extended time periods as sourced from the firm's data, and that was relative to the position of the individual properties financed by the bank. The precision level is 1 meter level accuracy. So the white-pink smudges are the areas impacted by the fires. The scatter points are the locations of the individual properties as financed by our bank, and the more valuable properties show up as a darker red. So the fire areas showing up as white-pink smudges on the left-hand image are an aggregation of all fires in the archive records, which was more than 15 years in this case, leading up to the fire event, whereas the blemished areas on the right include data for that particular event. So the right-hand image includes the fire event that we looked at. And you can see perhaps more clearly in the report that those smudges are somewhat enhanced post the fire event. So these images gave us a pretty useful idea of how close properties that we financed were to historical fires on the one hand, on the left, and then in particular fires, the fire event that we looked at. And we could get a sense of which properties that were located closer and their values relative to those further away from fire zones. we've just overlaid some yellow arrows to indicate properties that were closer to the fire zones and whose valuations declined after the fire event. So in terms of outcomes from the exercise, I realize the numbers there are too small to see, but in the report, as I say, they are clearer. The graphic on the left shows the results of the analysis. We used a common base value of 100 units, and the table reflects average values for the properties grouped by distances from the nearest fire and split out by the period before, at, and after the major fire event. The key findings from the exercise were, for the sample of properties that we looked at, the growth rates in values for all properties situated less than 906 meters. Interestingly, that's the result the application gave us. The growth rates for those properties decelerated materially after the fire event relative to the growth rate in values after the fire event for properties situated further than 906 meters from those fire zones. Through our learnings on the pilot program, we were encouraged to sense check and run sensitivity tests on some of our assumptions. So we did that for the 906 meter boundary line, which we defined as near properties if they were within that range. And we moved this distance assumption to 3 other boundaries, which are reflected in the columns in the table below. And what we found is that when we moved this assumption, in each of these 3 cases for both near and far properties, the overall average growth rates declined after the major fire event. However, for near properties at all 3 boundary levels, they declined relatively more than for those further away. And this assumption, or this outcome from the sense check, only changed once we reached 1,500 meters, where we did not observe this relationship. And that would suggest that perhaps at this distance, away from the fire zones, property values are not informed by proximity to fire zones. So this was a hugely valuable exercise for us in testing some of the methodology learned on the program for determining the extent to which climate hazards might inform asset prices. Some of the challenges include things like obtaining clearance for the use of customer data, certainly finding locational information such as coordinates is somewhat of a challenge, but this is a reasonable basis for us to start expanding this testing into the wider portfolio. So the question then is, how do we start translating the outputs from analyses such as these into tangible changes to our product offerings and our engagements with our customers around their business models? Being an Africa-centric organization, we're aware of Africa's unique vulnerabilities to climate change, both in terms of expectations for incremental warming and the consequent constraints that will have on GDP growth. Our organization's purpose is underpinned by a desire to drive Africa's growth, and to do that we've defined 5 value drivers, one of which we've termed C, that's SEE, value driver, social, economic, and environmental impact, the aim of which is to generate sustainable growth in a socially and environmentally responsible way. And one of the ways that we are seeking to do that, delivering net positive C impacts, is working with our clients in developing solutions for adaptation to the physical risk effects of climate change. To that end, similar to other banks, we've built a sustainable bond framework, which really sets the parameters for the issuance of sustainable green and social bonds that support lending to projects such as those for the adaptation to the effects of climate change. The allocation of proceeds from these bonds issued under this framework are to eligible loans and other assets within categories aligned to our C impact areas. So, for example, in the climate adaptation category, bottom right of the slide, projects that can demonstrate how the response to physical risks from climate change is addressed, the benefits of climate resilience are evaluated. Those type of projects are eligible for finance. You think of things like the expansion and maintenance of flood defense systems, agribusiness projects that are certified by agencies such as the Rainforest Alliance. So we anticipate that the outputs from analyses such as this case study correlation test could assist in refining our target market for sustainable financing, as well as structuring appropriate products that account for risks such as those yielded by this type of analysis. So an area that's receiving attention in this regard is our agri sector. In particular, our work on gaining an understanding of the dependence and the expectations around current and future water supplies. We are categorizing our lending book into high, medium, and low risk clients based on the risks to their businesses posed by expected water supply constraints, exacerbated by a changing climate. And this allows us to better understand our risk exposures. And David mentioned heat mapping a few minutes ago, and that's certainly another tool that we are looking to bring into our understanding of our portfolio. So our work with our agri clients to develop plans for them that include more resilient strategies is ongoing. Think of the diversification of crops and products towards more drought resilient options, better planning around food security, and improving flood and mitigation strategies, which Marieke also touched on. So I think that to conclude, our understanding of physical risks in our portfolio is at an early stage. The intention going forward is that we start building the results of assessments like these into things like a climate adjusted risk appetite, both at a sector level and at a transactional and counterparty level. If you'd like to know more about the work we're doing in this regard, please do look out for our ESG report, which will include our second TCFD report, expected to be published towards the end of March. Thank you.
And I hope for those tuning in that this is informative not only on what we're doing more broadly, but also how individual institutions are applying it. And so in the remaining few minutes we have left, I'd like to just have a brief conversation with my fellow panelists. And I think one of the questions that many people are interested in is thinking about how some of these insights and metrics will be applied in the future. So what advice do you have for your peers in terms of applying these, but also what insights do you have for how you may take some of these to influence potential strategy as well as engagement clients going forward? So anything for the industry at large as well as to get a perspective.
I'll have a comment first and then hand over to Marieke. So David, I think perhaps I touched on it partly towards the end of my presentation, that the learnings and the insights from exercises like this really need to be translated out of the risk arena in a sense. What we don't want is for our risk insights to operate in a vacuum. It's important that it's translated into the front line, the front office. So on our side, we will be including more members from teams like a sustainable finance, our corporate banking, our coverage teams, relationship managers, people who set strategy and are informants and contributors to risk appetite, so that it's not just, in our case, risk practitioners and ENS experts, but it's really the business leaders in the bank that are taking these results and adapting them into new strategies that meet our targets, in terms of Paris. That's perhaps some of my initial thoughts on it.
Yeah, and if I can comment as well, I totally agree with you, David. And what we saw is that what I said, we started 2 years ago to trying to quantify and qualify climate risk. And I think quantifying and qualifying is really the heart of the matter if it goes about climate risk, because first of all, you want to know, and also the management and the managing board, they want to know what kind of risk do we have in our portfolio. And of course, we are not that far yet that we can have one figure for all the risk we are running, like physical risk and the transition risk. But now what we see is that during this year and hopefully during the coming years, we are able to put the outcomes of the assessments in, if it is qualitative or quantitative, we can put it in policies, in standards, in procedures. And that's really a very important next step, because if you do that, then the rest of the bank is also automatically involved, because they have to read these policies, they have to understand these policies. And then most important is the engagement with the clients, because what we found out, and maybe David, you can agree, because you are focusing on food and agri as well, is that our customers do, in some situations, they do have much more knowledge about climate change than we do, because we have also a big pharma portfolio in Australia, in New Zealand, for example, in the US, and also in South America. And these people, they, on a daily basis, they work with climate change, and for them, it's business as usual. So what we want to do is we work on trying to quantify and qualifying. We will embed it in the risk framework, but on the end, what is important for us, and we're working on it right now, is building a climate risk assessment for our clients. And that's really to engage with the climates. So we can learn as a bank, and we can see how far our customers are, and hopefully our customer can learn from what we gather from other customers, and then they can benchmark. So that is our first, well, let's say deliverable. I'm not liking this word, but yeah, we work for a bank, so you work with deliverables. Our first deliverable for this year will be to set up a client engagement and assessment. And what we will do, we will start with input from client assessment, from assessments we make as a risk team. So, for example, if we look at physical risk, we're trying to pinpoint where the client is, in which physical risk area he is. And then second of all, we're going to start look into the specific idiosyncratic risks, so they call it, of that client. And then the third step is to see what the management of the client is regarding climate risk. Can he manage his physical risk? And so it's important to see what the impact of the client is on climate risk. It's also important what climate risk has, what kind of financial impact climate risk has on the customer. And if we sum everything up, including the management practices of the customer, we end up with the residual climate risk. And that is important, of course, for the bank to measure this.
Yeah, if I can just add to that, Marieke, I agree with you there. I think I particularly like your point around our customers understanding these risks in some respects even better than us. Certainly in the agri space, you mentioned Australia. The same holds true for Southern Africa. It's a dry region. Our agri clients are used to droughts and prolonged droughts, but I think it's the quality of the disclosures we are able to make under a TCFD framework is somewhat dependent on the type of information we can get from our clients. So there's a mutually beneficial opportunity here. We can encourage our clients to better understand these risks and manage them, and design strategies, perhaps through products that we can assist them with, or other, advice perhaps. The better they're able to build data that we can use as well to report enhanced disclosures around these things. So yeah, I think it's quite exciting.
Absolutely agree on.
Yeah, thank you both. I know we're at the end of time now, so just to wrap things up, but just to say from our perspective at UNEP FI that this is a topic that certainly, as David and Marieke said, really demands both a integration within your institution as well as with a engagement with clients, both current and future. And I think that it's through that we really begin to get to impact. These tools are ultimately only as effective as they are when it comes to driving that type of impact. And they've categorized some very good ways of doing that. So anyway, on behalf of this panel, I just want to thank everyone for tuning in, and we really look forward to the continuing sessions over the rest of today and in the coming days. So thanks again.
Thank you, David.
Thank you, David.